22nd, look at me, 2026 retirement board meeting. Note the presence of, I think Commissioner McKee's is coming online.
That's what he said.
Okay, note the presence of the entire retirement board. I'll ask Treasurer Salas to lead us in the pledge.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Oh. Not online yet? Yeah. All right, let's just go ahead and get started. Is there any public comment? All right. I'd like to make a motion to approve the October 29th, 2025 meeting minutes. Is there a second? Second by First Deputy Landauer. Any board comment? Hearing none, all in favor? Aye. Motion carries. So Kathy.
You can call me Kathy.
Can I call you Kathy? Yeah, okay.
Please do.
All right, come on up.
Do you guys have a presentation?
I do. Yep, I do.
I have it, have you?
Yep. Do you have a copy?
Okay, there's
Keep
hard
that
copies there.
memorized.
Okay. Yeah, there's a few over there.
Is Commissioner McKee's jump like?
Oh.
Okay, let's go ahead.
Just get started. Great. Well, good afternoon. Great to see everyone. So if you could start with the executive summary, I wanted to start off and congratulate all of you and the great work that you've done in 2025. And I want to congratulate you on the success of the retirement plan. You can see that the plan earned 16.45%. So it's the best return since 2019. So really, really strong year. It's interesting to think when we started the year, we went through April through July, and here we are today with record highs. So congratulations on that. You can see the market values here. I have the market value as of the end of last year, 652 million. And then we ended the year at 752 million. Strong quarter as well. The portfolio is up 2.56%. I do have yesterday's market value if you're interested. We had a couple bumpy days. Markets rallied yesterday and back again today. But yesterday's market value, which is not on here, is 761,614,000. So we continue to hit new highs within the plan. So that's great news. And obviously, your contribution within the plan, as well as the strong earnings, really helps support that market value. You can see year-to-date gains at the top here, 106 million for the 2025 calendar year. And when we look at, I'm just going to hit the high points. I know you guys had a very long meeting this morning. So high points are equities were a huge contributor. U.S. equities had a strong year, really led by artificial intelligence and the Mag 7. I've been talking about that every time I stand here, but we did see a little rotation out of those areas within the fourth quarter. There were some concerns about all the spending by these hyperscalers, the AI hyperscalers. So we did start to see a little rotation into other areas. We're seeing that more importantly in 2026. We're seeing, small cap do better than large cap in other areas besides mega tech, which is healthy. But I think one area that really stands out when you look at your equity performance is, and you'll see the numbers in a moment, international equities and emerging markets. So I have a benchmark here, the MSCI ACWI ex-US. That was up about 32%, and you participated in that. The US S&P 500 was 17%. So you can see almost double. And for years, that hasn't happened in decades. You've heard me talk about that. And as I stood in front of you for several years, US equity has been the dominant player. So when we look at your asset allocation, the diversification geographically in, different areas of the country, not just domestically, has really benefited the portfolio. And you can see equities are up year to date 23%. Fixed income had a positive quarter and year to date up 8.3% for the year to date. You'll see as well strong returns. US Treasuries, we had a steepening curve with the Federal Reserve cutting on the shorter end. And we saw other areas within fixed income like high yield and emerging market debt. Again, add diversification and really strong returns. Emerging market debt was up double digits. And then finally, alternatives. These are your, uncorrelated areas of return to the public markets. And you can see they continue to provide value up 11.5% within that group. And then this last point I thought is so interesting. We believe diversification first and foremost as a risk management tool. and, you know, for reducing portfolio volatility, but it really helped in returns for this year. So really nicely done. For the asset allocation, we did review it in August of 2024, and we did review it in 2025. We didn't come to a decision, but we're going to be working on that again. I know with Dean not being here, we're going to try and look at your investment policy statement as well. So that's an agenda item that we're going to look at for 2026.
Okay. Good.
Sound good? Any questions?
Sounds good.
Okay.
Any questions or comments?
The,
Well, I'm going to keep going if you want me to, or I can stop there.
no, oh, I just wanna,
Did you want me to? I can stop there. That's the
I'll
highlights.
defer to.
no, I just,
That's
Yeah.
up to you guys.
well, these are the highest returns since 19.
2019, it was up 20%.
It's up 20%.
Yeah, and I have the calendar year returns in there so you can see, but yeah, it's been 2022 was that.
That's what I'm trying to, I'm trying to think about, because that 2022 seems to be our
Yes.
thorn in our side.
Well,
when
that's
we-
going to roll off soon, I think, from your.
Well, it doesn't seem like it's
Never goes
going
away.
anywhere.
Never go away. But when you look at, you know, if we can jump right to the calendar. We had double-digit returns in the last 3 years.
Right.
Um,
I'm just trying to,
yeah.
I'm just trying to backtrack the 5-year, because I'm thinking about that 5-year window when we do the averaging,
Mhm.
you know, what because when we look at what we can and cannot do with the cost of living for retirees, and we've been limited to trying to do something until we could get past that 2022,
right.
that year,
Yeah.
which keeps us below that 80% threshold that we
Right.
have to when the,
With your cost of living.
yeah.
Mhm. If you can go one
So-
more slide, Tom, to answer your question. Yeah, one more. So I'm sorry. There you go. So you can see 24, 11%, 2023, 15, 2022 is at -15, and 21, 12. So if you think about 1, 2, 3, so it's still within that 5-year.
yeah,
So you really have another 2 years to have it drop off completely. If you're, well, 1 more year, I should say, right?
yeah,
One
I'm
more
just
year.
trying to, because when we were talking with the actuary, and because when we got all those numbers earlier, and you know, I said it over the summer that we're probably still 2 years out
Mhm.
before we could get above that. Just looking at projections, and we're probably 2 years out until we can get above that 80% threshold that prevents us from doing a COLA increase for our retirees.
Yeah.
So, and I know it's something that we've
Mhm.
talked about. I know that as 3 commissioners, we've talked about this. I know Commissioner White and myself talked about this. You know, what we could do, you know, how we could go about it. We looked at different avenues and different, you know, but we're just kind of in that, you know, restricted based on that 2022.
Yeah, you're under that threshold. I think it was 79 or.
Yeah, the
78.
last, it was like, I think it was a little under 79% this
Yeah.
year when the actuaries came back.
The good news is they typically use about a 7% estimate, 7.5% estimate. So the 16% or the 15% that you earned this year will greatly help that. But yeah, I think it's to your point, it's a forward-looking calculation. So you might have to wait until the following of the end of the year before that's actually
Yeah.
projected going forward.
Trying to figure out what was the common thing from 2019 and 2026 that is showing those kind of returns, or something that's been common. You know, what was
Well,
in 2019, and now we see it again in 2020.
Yeah, well, certainly, and when you look at COVID, 2022 was, you know, it feels like a lifetime ago. It feels like yesterday. We had inflation of 9%. We had a Federal Reserve raising rates
Yeah.
super aggressively. So the markets, every single asset class was negative, except you had alternatives. You had a small percent because you were at the majority of Vanguard, but they were the only asset class that was positive, your real estate exposure. But I think when you look at what's happening now, and I was going to put it in my comment, in my presentation, but I can jump right to it. There's a number of things, and we're positive on risk assets for 2026. And if you look at, you know, Tom, what's happening now and why you got a strong return, you have monetary policy that's very supportive globally. There were 160 cuts in 2024, 150 cuts globally, Federal Reserve cuts. in 2025, and there's expected another 70. Granted, we're probably at the end of our rate cutting cycle, maybe 2 are baked in or expected for 2026, but monetary policy is a tailwind. We have fiscal policy, the tax cuts, the big beautiful bill is expected to raise the average investor refund from 3,000 to 10,000. That's a 10-year average on Piper and Sandler. So we love to as consumers spend. So that extra refund is going to help with GDP numbers. So that's absolutely helpful. And then finally, you have earnings, strong earnings. So there's a lot of positives, but certainly as we saw just 2 days ago, geopolitical issues can rattle the markets and pull back. But I think there's a lot of positives entering into 2026, and you're seeing some of that return.
And I said this over the summer or at the last meeting, those geopolitical issues, it's market manipulation that occurs. And I always like to look why when we have this meeting where we're at with the market today and the market
Doing great.
today. So
Doing great.
we're going to see fluctuation.
Absolutely.
You know, I hope that we see another rate reduction
Yes.
in 26.
Yeah.
At least 2 would be.
Exactly. There's 2,
There's
maybe
2 planned.
June and at the end of the
Right.
year, but I think a lot will, with the government being shut down and unable to kind of get good, strong numbers on employment, I think that's going to be a lead factor to see how we are with
But
unemployment.
looking at all this, I think that if we have a strong 26.
Yeah.
Like we had in 25, it could get us to
It
wipe
could,
out
it could
that
absolutely help
22,
you. Yeah.
which
And
would
interest rates,
then put us in a position to do something from a COLA.
have that
standpoint.
Yeah, my hope is absolutely are. But there's the unfortunate thing that comes with 3 years of double-digit returns.
Well, there's always,
Market's very efficient, and
Right.
unfortunately,
it's always an adjustment.
yeah. So
Alrighty,
the good news, like I said, is we're seeing rotation now. The areas that have done exceedingly well, when you look at artificial intelligence, that was the majority of the gains, at least for US last year. But now you're seeing other areas within the
Right.
market
I
expand.
just hope that we could really have a serious look at the COLA.
Yeah, no, I know that's first and
Yeah.
foremost. And I think your asset allocation is very strong to get you there with risk management and other areas that aren't correlated with your alternatives to help you. So we can walk through performance, or we could end it there, or we could.
Just some high notes.
Okay,
would be good.
then you want to jump back? Keep going, sorry, keep going forward. I apologize. Let me give you a page number. Go to portfolio review, which is. Right, one more. Okay, so that's just the reconciliation. Year to date, 106 million gains. If you go to the next slide, just shows the portfolio by fund. You can see 16.45 on a gross level. Equities, if we just look at the year to date, 1 year number, 17% for US equities. Your international exposure, as I mentioned, your global equity, 32%. So really value there, the weakening of the US dollar. They had strength in artificial intelligence, some really strong emerging market economies. You can see really paid off nicely. In your fixed income, lots of diversification there too. If you look down the line, your investment grade high quality bonds at 7%, but look at emerging market debt, 20%. So even areas of fixed income, a little bit riskier, paying off very nicely. And versus the benchmark is 16%. So we've talked in the past about active management, and what that means is that SEI managers are picking stock actively, right? You're not just in a passive strategy within your US like you are in your US and international. So those 4% adds additional value to the plan too. So active management has helped you as well. If you don't mind going to the next slide, the continuation of fixed income, high yield bonds up over 8%. That's been a nice contributor for the last 3 years. Alternatives, 14% for your special situations. That's your hedge fund, adding that additional value. And your structured credit continues to do well. And then I'll end it on the dynamic asset allocation fund. That fund was up 20% versus its benchmark of 17. That benchmark is an S&P 500, but that fund allows us to implement a short-term point of view within the markets. And there's been active trades within that fund. We know about commodities. We had a gold position. That's done exceedingly well. We did cash out of that. And we also have exposure to emerging market currencies and the steepening of the yield curve. So all areas that continue to benefit. So that's it from a performance perspective. I'm happy to answer any questions about the market or highlights.
Any questions or comments?
Well, thank you.
Great, thanks for the
Great.
question.
No, thank you. Appreciate it.
Yeah, my pleasure. Great to see everyone.
Okay. Next up, we have an update on the criminal proceeding mandating forfeiture.
Okay, and the controller's office is notifying the retirement board that the two former employees now retired to the county have been convicted of stealing government funds. Patricia Altusa and Lisa Shoba each pled guilty felony charges of theft by unlawful taking and theft by failure to make required disposition of funds received. For the PA Public Employees Pension Forfeiture Act number 140 of 1978, it mandates the forfeiture of pension benefits for public employees convicted of these specific crimes related to the public office. This is a case for both of these individuals. They will forfeit their pension benefits and will be entitled to a return of the pension contribution without interest. It is permitted to have restitution taken out of these amounts. They've been receiving pension payments with a cumulative amount to date below their own contributions, and they have already filled the restitution amounts. We plan to notify the individual of the required forfeiture next week. There's no vote needed.
Okay, thank you.
Thank you.
I'd like to make a motion to adjourn the retirement board meeting. Is there a second?
Second.
Second by Commissioner DeBello. Any board comment? Hearing none. All in favor?
Aye.
Aye. Motion carries. Meeting adjourned.